Hi there, Michael Hill Jewelers. My name is Travis Bailey. I'm Senior Financial Planner from Advice First. And thank you for joining us for the annual Superannuation webinar. We're the servicing advisors of the existing or older default fund for Michael Hill Jewelers, which was with AMP. So this presentation is an update in relation to some changes to superannuation and also just highlighting some features of the Michael Hill Jeweller AMP fund for those that are in the fund. What I'm going to do is I'm going to share my screen with the presentation and run through the content. So today's presentation is of a general nature. So any of the information is obviously doesn't consider your personal circumstances. But in the invitation email for this webinar, there was also an option for you to book in a one-on-one to either ring Kim, my assistant, or you can use the QR code to go ahead and contact us to book in a one-on-one where we can then discuss your personal circumstances. Moving forward, if you obviously have any queries in relation to your super, whether you're with AMP or not, you're more than welcome to reach out to ourselves as well. So today's agenda, we'll talk about firstly who are Advice First, get you thinking about retirement, just to see whether you're on track for a comfortable retirement, growing your super, how to contribute money into your super, and getting the most out of your superannuation, just some extra tips there as well. And also if you want to learn more, just some engagement tools as well. So who are Advice First? We're a privately owned financial planning firm. We provide financial advice, education and support. We've been supporting Michael Hill Jewelers and their employees and AMP members for over 17 years. So it's been a long-standing relationship. We specialise in advice and education, and we've been around for 42 years ourselves. So we're Gold Coast based, one of the largest in Queensland. And we service private clients. So if you or your family need a financial advisor that obviously you can go ahead and trust, reach out to ourselves and we'd love to assist you. We also help commercial and corporate clients, both nationally and internationally as well. Thankfully, we've got 9 qualified practitioners who specialise in all different areas of advice. So depending on what your needs are, the beauty of our firm is we're able to go ahead and align you to an advisor who has that specialised background and also knowledge to help you, and also to align you with, I guess, the right character of advisor as well. We provide objective advice, so we can look at any super fund, investment, pension strategy, and take that then to the market using our approved product list as well. The beautiful thing about our firm as well, and we're very proud about that, is that we have a 95% retention rate of private clients. So I guess we've got the infrastructure and the processes in place where we're here to go ahead and deliver advice to you. Look, it's equally as important to us as it is to you, to go ahead and build a bond and a relationship to see you through your working life or also your retirement life as well. So let's get thinking about retirement. I guess the major things that we're asked is, how do you want to live in retirement? And that will then also determine how much you need in retirement as well, depending on what your lifestyle is, what your costs are, and also how long you're going to live for as well. And we'll talk about some numbers around that as well. And also where you want to live is also will determine what costs are associated with obviously your lifestyle in retirement. And also, are you going to change where you're going to live as well? So when we take into account those 3 things, how you want to live, how long you're going to live for, and where you're going to live, then it helps us determine roughly how much you need to accumulate for your retirement years. Now, to be able to I guess, get an understanding as to what the amount required in retirement is, there are some simulators that are available for you. And these simulators are provided, you can find them online, but I've provided a couple here for you. And these simulators are there to design or provide you with support as to whether you're on track in relation to your superannuation savings. And then also I can give you an indication as to, where you're going to land when you actually get to that retirement age, and also whether then that amount is going to outlive you or outsee you, or also provide you with the lifestyle that you need through your retirement. So you can see there's the AMP simulator there, and I've provided the AMP browser address there. And that's quite an easy to use tool for you to then go ahead and put in details reflective of your circumstances, for you to go ahead and obviously receive the illustration in relation to your retirement planning. There's also a superannuation calculator that's on the Money Smart website. They've got a number of different websites available, but this one's a superannuation calculator where you put in your age, what income you're earning, your desired retirement age, and then also how much you've got in super, and that'll help go ahead and accumulate and project roughly how much you've got. So I've provided also the browser address for that, for you to access those. So look, jump online. This will give you obviously it's the first step as to, okay, where am I going to land? And it'll give you an indication as to how things will look. And then you can reach out to us as to, having a discussion as to, is that going to be enough for you? And that's where we can, sit down with you individually to talk about, how to go ahead and maximize the amount out of your superannuation. So when it comes to your retirement goals, I guess the question you ask is, are my employer's superannuation contributions going to be enough? So firstly, superannuation is an accumulation vehicle for your retirement, and it's legislation that your employer contributes 10.5% of your gross income. So whatever you earn, 10.5% of that is contributed into super. That amount is taxed at a rate of 15%, and the super fund sends that tax off to the ATO automatically. So you've always got this money that's coming into this accumulation vehicle from your employer, and that's going to obviously compound over the years. But is that going to be enough, just your employer contributions? So then we look at, okay, well, what are the other options available for you to grow your superannuation? That's why we start talking to people about salary sacrifice contribution, making some additional contributions yourself into this long-term investment that's just going to help maximize the growth component of your super. And then you also take into account the age pension age at the moment is age 67. So will you be eligible for the age pension when you actually get to that age? And how will that go ahead and obviously subsidise and impact your superannuation savings so they can work hand in hand? So there's a lot of things to take into account. And with that, we encourage people, you can't do it on your own. You need some specialised advice. And like I said, we've been specialising in this field for 42 years. So, it can be quite daunting, quite overwhelming. And also there's a lot of the unknown. There's a lot of moving parts when it comes to this topic. Go and get advice, go and find a trusted advisor that's going to help you with making these decisions on how to maximise this retirement savings pathway. When we look at your retirement age, it's different these days. Back in, say, 1909, in 1909, the age pension age was age 65. Superannuation employer contributions, they weren't the norm. It didn't happen. There was no real retirement superannuation savings scheme in place. So predominantly, males would receive the age pension at age 65. And about half the male population only lived to age 65 back then. So superannuation or even retirement planning wasn't really spoken about. And look, on average, the time spent in retirement for a 65-year-old was about 11 years. So you didn't really need to probably accumulate as much or think about retirement as much, because it just was it was a shorter period of your life. But now we fast forward, and this slide takes you to, say, 2018, a few years back. But you know, now the life expectancy of an average male is age 80, not 65. And the average time spent in retirement is now about 20 odd years. Females even are expected to live longer until age 85. So look, it just shows you that we are living longer. We're working until, say, our 60s or 65, up to 67, which is your age pension age, when you can obviously get Centrelink there. But we need to also consider providing for our lifestyle in retirement for about 20 years. So that's why superannuation is in place and why we need to engage with this as early as possible. When we look at a comfortable retirement, research performed by the Australian Superannuation Foundation Association, it shows that for a comfortable retirement, a single person may require a lump sum of around about $450,000. And a couple, they require a lump sum of around about $640,000. So that's a lot of money to accumulate to provide for your retirement for, say, that 20-year period. And that's based on the average budget and living standards for those around the age of 65 as of now. It also assumes that to live comfortably, a single person would spend approximately around about $46,500 per year, while a couple would spend around about $65,500 per year. And these figures also assume that you own your own home as well when that's paid off. So let's have a look at what a comfortable standard retirement looks like. So I showed these numbers earlier in the past slide. So the minimum annual costs of a comfortable retirement for a single person, around about $46,500, and for a couple, around about $65,500. So that's showing, that incorporates your daily essential costs such as housing. You can see all of the costs associated with just living there in your home. Groceries, fresh food, pantry, toiletries, transportation, whether you're taking public transport to fill your car up. These days is quite an expensive ordeal due to the current inflation rates. And also just maintaining a car as well. Buying, obviously, your standard clothing and footwear, upgrading that per year, but also staying fit and healthy. It's a priority in retirement as well to go ahead and protect our longevity. So looking at your health insurance, your costs at the pharmacy, and also visiting, your specialists such as doctors. And then also maybe joining a gym, exercising, doing aqua aerobics, yoga, bowls, whatever that is. And also staying socially engaged, basic enjoyments in life, going to the movies, streaming services, going to the local pub, haircuts. These things are all incorporated in these standard comfortable costs of living. And then also connecting with your family through your computer, internet, mobile phone. If you've got someone who lives interstate, domestic flight, or even one international flight every 7 years. So for you to live a comfortable standard level of living, this is obviously what that incorporates. So it's just a basic everyday lifestyle, nothing too extreme for you to be able to generate that sort of income. For you to, I guess, have an understanding as to what your standard or comfortable living is and what your annual lifestyle income requirement is, you can also jump on this website here. So this is an AMP retirement standard calculator. So this is you plugging in really, what your bills are, what your costs are from your everyday living. Try and foresee what that looks like in your retirement years, and that'll give you an idea of roughly what your minimum standard of living costs would be as either a single person or a couple as well. And that'll then help determine, am I accumulating enough? Is that then going to generate the annual income that I need? And then you can start bridging the gap from there to see whether you're going to reach that goal, or whether you're going to be short and need to obviously place some emphasis and attention towards that. So why do we grow our super, our money in our super, or our retirement wealth in our super? It's because in super, you can see on the right-hand side, the tax rate within super is 15%. Like I said, when your employer contributes into your super, it's taxed at 15%. Any income earnings within your superannuation is taxed at 15%. And then when you actually use this money in retirement, you start to receive some tax advantages and incentives as well. But any money within super is taxed at 15%, which is a reasonable rate of tax, especially for higher income earners. When we look at personal income tax rates, you can see there that the highest marginal tax rate there down the bottom is 45% for anyone earning over $180,000. So super then tends to be quite a attractive vehicle for people on higher incomes. The other beautiful thing about superannuation is it's locked away. You can't touch it until you get to your preservation age, which for the majority of us now is age 60. So you can't access your super until age 60. So it provides obviously an environment where you're not touching the money that's put aside for you. That money's invested into a portfolio, which I'll talk about. But that money's also, and those interest earnings are compounded. So when you earn interest on top of interest, that's called compounding interest. So the good thing about super is it has obviously the environment to maximize any compounding interest effect as well, because we can't touch it until age 60. And then when we get to age 60 or 65, we're going to live for another 20 or 30 years. So you can just imagine the compounding interest throughout those times. I spoke about where to invest your money. So when you first enter your enter our superannuation fund, you're placed into a default investment option. And that's usually a diversified portfolio put together by your provider. Where you can invest your money in defensive assets, they call them, or asset classes, or growth asset classes. Now, the defensive asset classes or assets are cash, bonds, both government and corporate bonds, and they earn you between, say, 0.5% up to about nearly 2.5%, 3%. And then on the other end of the spectrum, you can invest your money in growth assets, which are listed property, and also equities, or also shares that you would have heard. So that's investing in companies like Microsoft, or banks, pharmaceutical companies, IT companies, every sector you can think of. There are businesses and companies within those that you're investing, and they make a profit. And because you're a part share owner in these trusts, you receive a proportion of that growth share price, and also distributions through profit distributions as well through investing in shares. So you've got growth assets, shares and property, and then you've also got defensive assets, cash and bonds. Now with AMP and a lot of corporate super funds, when you first join, you're put into that default investment option. Now with AMP, they have a My Super cohort, which is, depending on your decade of birth, you will put in, say, the 1950s fund, or the 1960s fund, the 1970s, 80s, 90s, 2000s. So the younger you are, so you can see here, down the bottom, you've got the member's age, and then on the left-hand side there, you've got the allocation of growth assets. You can see the little squares down the bottom, growth assets represented in dark blue and defensive assets in light blue. So if you're, say, 22, entering the supermarket, the superannuation industry, you would automatically go into a high growth investment where you've got about 95% of your money invested in growth assets and about 5% invested in defensive assets. And as you start transitioning through your working life, you can see there that even in your 30s and also 40s, you've still got a very high exposure to growth assets, because shares and property give you higher rates of return, where cash and bonds give you a lower rate of return. But shares and property come with more volatility, but over time, they are the assets that are there to really help grow your investments. But with these investments is as you start to transition through your working life and you start getting into your 50s or your 60s, you can see even when you get to age 65, you have around about 55% of your money exposed to growth assets, and then you've got 45% money of your super balance exposed to defensive assets. So you start to de-risk, and you're not taking as many extreme risks as you were when you're in your 20s. So these are your default investment options, exposing you to growth and defensive assets. But then again, if you wanted to speak to us to look at investments outside of the default portfolios, AMP have a large range, and also any super provider have a large investment menu available for you to discuss to see whether there's an alternative investment portfolio for you. Contributing into superannuation, well, as you can see, this is a long-term investment. There's money going in from your employer. It's invested in a portfolio, but then you may want to start contributing a little bit more to get ahead of the pack. So you can contribute into super. And it's important to understand that we have these contribution caps. So you've got limits as to how much you contribute into super. You've got concessional contributions, where the maximum cap is $27,500. So a concessional contribution makes up of any employer contributions, and it's called a concessional contribution because it's only taxed at a concessional rate of 15%. You can also make salary sacrifice contributions. When you salary sacrifice into super, once again, you don't get taxed at your marginal tax rate. You only pay 15% tax. And then also you can make an after-tax contribution and claim that as a tax deduction. So those contributions are called concessional contributions. And the maximum you're allowed to put in at a concessional rate of tax of 15% is $27,500. Okay. You can also make after-tax contributions, also known as a non-concessional contribution. So there's no concession on tax. And the amount you're allowed to put in, so you can receive your money as an income, it sits in your bank account, you've paid tax at your marginal tax rate, then you might decide to put some money into super from your bank account. You don't pay tax again, and the maximum you can put in per year is $110,000. I spoke about salary sacrificing. So that's predominantly directing some of your pre-tax income into super to boost your retirement savings. Like I said, when you salary sacrifice, you pay a 15% contributions tax when the money goes into super. Okay. And that money is invested in a highly tax effective super environment like I spoke about. Earnings within your super are taxed at 15% as well. Earnings outside of super, as I said, they're taxed at your marginal tax rate. So that's why some people do put money into super, to go ahead and just avoid paying high levels of tax. Here's an example. So you've got someone on the left-hand side here who's normal scenario on an income of $75,000. The total amount of tax they've paid on that is around about 21.76%, which is about $16,342. So the amount that they take home is around about $58,600. Now, if we look at a salary sacrifice scenario, same person on $75,000, but they've decided to take $70,000 as income and contribute $5,000 or salary sacrifice $5,000 into super. On the right-hand side, you've got $5,000 going into super. The tax on that is 15%, which is $750. On the left-hand side, you've got $70,000 in salary. The tax on that salary is then $14,617, which has brought that marginal tax rate down to about 20.8%. So the total tax paid with 70,000 and 5,000 is 15,367. So that's a tax rate of about 20.48%. Now, the thing is that you've taken a bit of a hit and a reduction on your income. So your take-home pay is 55,383. You've got $4,250 go into super. So the net amount there in its entirety is about $59,633. So you can see, compared to the two, by salary sacrificing $5,000 into super, you've got ahead and saved yourself probably close to about $1,000 in tax. So that's the tax incentive that super has. Imagine what that looks like when you make, maybe $10,000 or $15,000 salary sacrifice contributions into super over, say, a 30-year period, the amount of tax that you're able to save over that period. So how do you start to salary sacrifice? Well, you calculate how much your employer or SG contribution will add up to for the financial year, and then think about how much you want to contribute from your future salary, maybe from a bonus, or maybe from some leave entitlements. And then talk to us, give us a call and say, look, this is how much my employer's putting in. This is how much I'm thinking I'm able to part with per year. And how does that impact you from a tax point of view? And then we'll let you know whether it's worth doing or not. And then if it is, then put an agreement in place with your employer. So you'd reach out to your payroll department and say, look, I'd like to start salary sacrificing into my super. This is how much per pay cycle. And they will set that up. And that's a contractual agreement between you and your work and your employer. So it's pretty simple to set up. So contributing to super, non-concessional or after-tax contributions. Really, it's there to provide you with just extra boosts, extra contributions into your superannuation. When you make that after-tax contribution into super, like I said, you don't pay tax on that contribution. You can claim that as a tax deduction, and if you do, up to a certain level, that would then change that to a concessional contribution as well. But you can make contributions into super after tax. And that might be something like, you may receive an inheritance, or could be a gift that you want to then make that lump sum contribution into super. I spoke about making a contribution into super, which is after tax, and you can then claim that as a tax deduction as well. Contributions to super using unused super contributions. So you can make you can have a catch up, or it's called a carry forward. So it says there that now you can put more into super at the concessional rate of tax starting from 2019-2020 financial year. So those who are eligible to make catch up contributions. So the concessional rate of contribution cap is $27,500. If you don't use up all of that concessional cap in one financial year, let's say you only put in $17,500 per year as a concessional rate, that means there's $10,000 left over. You can carry that forward for next year. So you can put in $27,500 next year plus the $10,000. So that's $37,500 as a catch up. And you can look back 5 years for that catch up. The 5-year carry year forward, that started 1 July 2018. It applies for people up to the age of 67. If you're over the age of 67, you still need to meet a work test. So just give us a call if you're unsure. The unused amounts can be carried forward regardless of your total superannuation balance, but expires after 5 years. Give us a call if you want to know whether you can carry forward some unused contributions. There's also a bring forward rule for after-tax contributions or non-concessional contributions. You've got to be under the age of 67, and if you are, you can put in not $110,000 per year, but a lump sum of $330,000 per year, which means that you're bringing forward pretty much 3 years in one hit, but you can't make any further contributions for another couple of years. So if you do come into some money and looking at making a lump sum contribution into super, give us a call and we can let you know what you can carry forward. If you're over the age of 67, unfortunately, you can only make $110,000 per year. There are spouse contributions as well. So if you earn less than $40,000 per year, your spouse may be eligible to receive a tax rebate by contributing some money into super, making a after-tax contribution. So if you want to find out what those contribution limits are, and also how much your spouse and how much rebate they can receive to offset their tax, you can give us a call. Market competitive fees. So yeah, look, the fees are for the AMP Michael Hill Jeweller Fund. You can see here broken up in those cohorts. So if you're born in the 1960s, 70s, 80s, or 90s, as an example, the investment fee is 0.26%. It was 0.3%, but it's now been reduced. Administration fee across the board is 0.29%. The member fee is $6.50 per month. It was $6.57 per month, so that's recently been reduced. There's an indirect cost ratio fee, and that obviously varies depending on the decade of birth that you're born in. So if you look at the total fees, say for someone that's born in the 1970s fund, $78 per year plus 0.9% per annum. And the total cost for someone that, say, has a balance of $50,000 would be around about $528. It was initially $540, but with the new discounts from those fees brought in, it's a little bit reduced. So depending on obviously your investment portfolio, you can speak to us as to what your total fees are per year, but these are based on the MySuper default investment options and those cohorts. When you join the Michael Hill Fund, you would have received some default level of insurance cover. You can receive default death cover and TPD, which is total and permanent disability insurance. So it's a lump sum that's paid for you in the event of death or if you are unable to work ever again in your occupation. All employees, it's an age-based formula for your default level of cover. You as a member pay for the insurance premiums for this cover, but it depends on your age. So if you're 40, say under the age of 36 years of age, the standard level of cover for anyone under the age of 36 for death and TPD, you'd receive $80,000. But you can see there that you receive 2 times the standard amount of cover. So you'd receive $160,000 as a default level of cover. As you obviously mature through life, the level of cover actually reduces. But whatever those amounts are, times them by 2 because you receive 2 times your standard cover. You also receive salary continuance. So that's for full-time or part-time employees only. And that's if you're sick or injured, unable to work, and you're under the prescribed treatment of a doctor, you can claim on your salary continuance. Now that's got a 90-day waiting period, and you can actually get paid 75% of your salary. All right, and that pays you out for a total of 2 years. And after 2 years, you'd have to source alternative avenues for income. But salary continuance is a default level of cover when you first joined. When we're talking about insurances, let's also talk about nominating a beneficiary. It's important to understand or have in place, if you were to die, where would my super go? Where would my death benefit go as well? So this is where you nominate a beneficiary. It only takes a few minutes to do. You can do it online now through the AMP portal, or you can simply ring us and we can send you a form for you to complete. But you can nominate, it's got there your spouse, including a de facto relationship or even same-sex couples and marriages. You can also nominate your children, a financial dependent, a legal representative or your estate. So if you don't have someone who's financially dependent on you, like a child or a spouse, you can then leave it to your will or your estate for them to then distribute. So it's important that you actually have a will in place. Or also someone that you're in an interdependent relationship with. So just jump online or give us a call and check to see whether your nomination is in place. When we looked at the amount of members in the AMP fund, there was only about 25% of people that had nominated beneficiaries. So if that's you, please give us a call and we can go ahead and help you with that nomination. If you want to learn more about your superannuation, AMP and most providers do have an app available for you. Simple, just download the app and then that will bring up all of your details in relation to your balance, where you're invested, the amount of insurance you have, and also who your beneficiary nomination is as well. There's also financial wellness support as well. There's programs available through AMP. There's face-to-face, phone one-on-ones. That's for us. You know, give us a call and we're able to go ahead and filter your call or maybe help you on a general nature in relation to giving some general support in relation to your superannuation queries. AMP also have a podcast available, and there's also complimentary phone-based advice. But like I said, we're financial planners as well, or advisors. So give us a call and we can go ahead and align you to one of our advisors if there's anything that you need outside of the scope of your general insurance, your general queries in relation to your super. AMP also have help series webinars, webinars that are available to help you understand a little bit more about your super, understanding market and economic updates, getting your super on track, and understanding your super investments, which I touched on today, and also women in super. And if you are made redundant, there's information or some webinars available in relation to those too. So there's a wealth of knowledge available through the AMP portal. Us ourselves at Advice First, we're on social media outlets as well. So our platforms are with Facebook, Instagram, and LinkedIn. They're our addresses, so you can look us up. And each week we have important, valuable articles of information stemming around wealth creation, insurances, protecting your wealth, retirement planning, tax, borrowing money, and even estate planning and wills. So these are articles where we provide you information that you can share with you and your family, just to keep you abreast of additional information outside of the superannuation environment as well. Finally, if you need to contact us, like I said, there's our QR code where you can jump on that, request to book a one-on-one, or you can simply call Kim, my assistant, myself. There's also Lisa Forbes. Lisa is our internal home loan specialist. She's a partner of the business as well. If you're looking in the market for finance for a home, or looking at maybe a health check in relation to your current circumstances with your current provider, or you're new to the home market, give her a call. She's instrumental in what she does. She is a broker as well, so she can go out and broker the market for you as well. And then for any other queries, you're also welcome to contact AMP as well. So that concludes the annual superannuation webinar. Thank you for tuning in. Like I said, if you've got any questions, feel free to reach out to us, and we're happy to help you and your families. And I hope, we can cross paths and help you when in need. But thank you for attending, and we'll hopefully speak to you soon. Okay, cheers.